Using a traditional IRA is a great way to save for retirement and reduce your tax bill. In today's video, I'll show you exactly how much you can save so you can determine if it's worth it to deposit money into a traditional IRA. Also, if you're really disciplined with your finances, you'll get a bonus tip on how to get the most from your tax savings at the end of the video. What's up? My name's Maggie Gomez and I drop videos every Friday teaching beginners how to invest and feel confident in their financial life. I'm a certified financial planner and have worked as a financial advisor for Morgan Stanley and E-Trade. I eventually left to create Money with Maggie, where you can receive professional financial guidance regardless of your net worth. Take a look at my services in the link below and let's get started. First off, be sure to run this stuff by your tax advisor because I'm not a CPA and I'm simply giving you things to consider. Also, look at your income tax bracket to confirm that you're eligible to receive a deduction. Today's video assumes you fall into that criteria, and I've linked a chart below so you can make sure. The whole point of using a retirement account is for the tax benefit it offers. The retirement system may look a lot different down the road, and some people choose to take mini retirements along the way versus one long retirement at the end of their work life. But regardless of how you see your life play out, it's still smart to set money aside for later and save yourself on taxes now. When you put money into a traditional IRA, you reduce your taxable income, which reduces the amount of tax you have to pay. If you save for retirement in a regular bank or brokerage account versus a retirement account, then you'll be missing out on tax savings that can be significant over time. Here's an example of how much tax you can save every year. Let's say you're single and make $50,000 a year in 2021. This would place you in the 22% marginal tax rate, meaning you pay $4,617 plus 22% of the amount over $40,125, which equals $6,789 that you would owe in tax on $50,000 of income with no other considerations. You can pause this to see my math, which I'll also place in the description below. If you contribute the max of $6,000 into your traditional IRA, your taxable income is now $44,000. You're still in the same tax bracket, but now the amount over $40,125 is less, and you end up paying $5,469 of tax on $44,000 of income versus $6,789 that you paid on $50,000 of income. To find the difference, we take what you would have paid without the contribution to your IRA, which was $6,789, and subtract what you would pay if you did make the IRA contribution, which was $5,469. And we find that you would pay $1,320 less in tax by making the traditional IRA contribution. When you retire and pull that money out to fund your lifestyle, you'll pay tax on it then. But it will be based on your income tax rate at that time, which may be lower than it is now. So that's something to take into consideration. Be sure to subscribe if you're new here because I will be putting out more information about this. If between now and retirement, you invest that $1,300 every year for 30 years, you'll have an additional $134,000 if you average a return of 7% per year. This is an essential part of this strategy because this extra growth will help you pay the additional tax you may owe in retirement. It will require you to be disciplined with investing as well as have the capacity to invest that much as well. This allows you to keep more of your money in hand. Also, with a Roth, you don't see that tax savings now, but later you'll receive your income tax-free. So it's sort of a built-in savings and investment plan. If you don't have the ability to go through the extra step to figure this all out, then you can just go with a Roth. And in either case, remember that something is better than nothing. An easy way to see what your tax savings would be is to enter the amount of what you could place into an IRA in your tax software or have an accountant do this for you and see what the difference in tax would be for you under those exact circumstances. Then if you like the amount of tax savings that you have, it could be worth it for you to make that deposit into your IRA. Make sure you get that money invested after making the deposit so it can start working for you. If you need help with figuring out how to invest in your IRA, take a look at this video where I do break it down for you. Then you'll need to invest the tax savings in a brokerage account. So take a look at these two videos for help with that. And since we looked at how much your tax savings would grow, let's also look at how much your retirement deposits will grow that same time. So $6,000 deposited every year for 30 years at a 7% rate of return would grow to over $600,000, and take a look at how that breaks down with your contributions totaling $180,000 and your growth totaling $400,000. That's pretty incredible. Now, if you don't have 30 years to invest or aren't able to deposit $6,000 every year, please don't feel discouraged. Just do what you can and add on as you can. I've linked the calculator below so you can enter your specific numbers that work for your budget. Also, if you break that deposit down into bi-weekly or monthly contributions, you have more opportunity for growth just by getting your money to work for you sooner. If you'd like some individualized help with your finances, take a look at my services in the link below. Thanks so much for watching. Give me a thumbs up if you found this helpful, and I'll see you next week. Bye.